I'm joined today by Phil Strano, Head of Australian Credit Research at Yarra Capital Management. Phil is among the incredible investors sharing insights at the Family Office Investment Forum today. Welcome, Phil. It's great to have you with us.
Thank you. Really appreciate the opportunity to be here. Let's
dive straight in. How are interest rates and the recent tariff shocks impacting the relative value of Australian credit compared to offshore markets?
Yeah, so it's been a really interesting period. Obviously, any risk-off period, you're obviously cognizant of making sure that you continue to do what you tell your investors you're doing. So look, from our perspective, this risk-off period has restored a fair bit of value in Australian credit because we have seen kind of credit spreads push out by 20 to 40 basis points on average. But and pleasingly, the running yields that we kind of talk about with investors providing that kind of defence and offence that we've seen, that's been a theme of Australian credit for a while now, has basically shone through. So all of our kind of multi-sector portfolios have been positive performance through March and April, which is really pleasing. From a relative value perspective compared to global credit, Australian credit is very well positioned. So the Australian credit landscape is offering far better returns than the equivalent credit risk in, say, the US market, with far less risk around spread duration.
And given the exponential growth in Australian private credit, what are the key risks investors need to consider?
Yeah, interesting market. So there's been a lot of growth in private credit in Australia. And that growth has come in a really short period of time. And anytime you see that kind of growth, you have to become wary in terms of making sure that those assets are actually allocated in optimal formats, consistent with what investors expect. And to some degree, I don't think that has happened. This is why you're seeing increasing kind of risk and headline risk around rising impairments in private credit. You also have issues around kind of exclusive private credit portfolios that have issues around transparency, around valuations. That is another theme that's starting to really percolate. And also liquidity is an issue in that market because you have certain structures out there that are offering kind of monthly or quarterly liquidity purely backed by liquid assets. So the extent that they can provide genuine liquidity to their investors, that is an issue which may or may not become a concern for investors. And finally, I think, and it's happening, it's starting to occur now and is likely to continue, is that you're going to be seeing, or you have been seeing, a lot of these kind of private debt positions being converted into equity positions, which is not something that investors actually bargained for to begin with when they went into these vehicles. So there is a place for private credit in Australia. I just think that it has grown way too quickly. I mean, we do private credit, but we do it in a format consistent with the multi-sector portfolios that we manage, which has a much wider opportunity set, much larger. An opportunity set where private credit plays a role, but it plays a role consistent with the size of the market that it should be.
With investment-grade credit yields now offering returns comparable to long-term equity returns, how should investors think about balancing credit and equity allocations in the current environment?
So, look, I mean, our view is that equities are expensive. Despite the sell-off that we've seen, equities kind of remain pretty expensive territory, especially when you compare them to the kind of first Trump administration. So when we look at credit, for instance, we think overall credit is far more attractive as an asset class. We think investment grade is fantastic because you can actually genuinely kind of generate yields now, running yields of 7%, returns of 7 to 8, which are akin to long-term equity market returns. So with investment grade portfolios now, you can get longer-term equity market style returns without the volatility associated with equities and without the impairments that you typically get through a high yield default cycle. So it's incredibly attractive.
Why are multi-sector credit strategies considered optimal for achieving higher risk-adjusted returns? And what advantages do Australian credit markets specifically offer?
So when you think about Australian credit, I mean, Australian credit is in its blocks or in segments. They're all meaningful, but they're not huge. The real advantage of multi-sector credit is you're actually looking at an opportunity set which is massive when you combine them all together and you look at it from a multi-sector framework. So the opportunity set across multi-sector credit is roughly about 1.8 trillion. and this is based on the RBA statistics. It's not stuff that we made up. And that's akin roughly to the same size of the ASX. So the real advantage of multi-sector credit is that you have optimal ability to focus on risk-adjusted returns through a cycle, and it gives you a lot more flexibility to actively manage your portfolios to do the right thing by investors on risk-adjusted returns.
As global equity valuations remain elevated and government bond curves steepen, what role does Australian investment-grade credit play in building a resilient portfolio?
Yeah, so the beauty of investment grade, once again, is it doesn't default, and that's the beauty of it. So you don't really have any kind of permanent loss of capital. Now, in relation to steepening curves right now, the real advantage is that you're able to kind of invest in longer dated assets and derive quite significant kind of yield, but also kind of capital growth, because you have these securities kind of roll down the curve faster, if that makes sense. And I don't want people to get caught up in the jargon, but it does mean that you're going to be able to generate quite superior returns without necessarily taking undue risk.
Thank you, Phil. We're going to have to leave it there and get back to the forum. I really appreciate you sharing your expertise with us today and for being a part of Global Investment Institute's Family Office Investment Forum.
My pleasure. I look forward to the next interaction.